how do you make money on companies that only lose money? Is that a paradox? Or do you just have to get lucky? In this video, we are going to talk about how you properly invest in companies that are not profitable. Now, usually when we think about companies that are not profitable, we think that they are doing something wrong. But in many cases, it can actually be smart to lose money. Now, one of the sort of pinnacle examples of a company that consistently lost money year after year after year is Amazon. Amazon, for decades, would invest in infrastructure that would allow them to build out their e-commerce retail operations, which came at the cost of profit. In fact, Jeff Bezos purposefully didn't make money in those early years. And he did that because any money they would have theoretically made, they reinvested back into the business. Now, today we're going to talk about when is this smart and when is this stupid? Because there are times where you will look at a business that is losing money and they will never make money again. In contrast, there could be companies that consistently lose money but do so smartly. So what is the difference between losing money stupidly and losing money smartly? Now, to understand this, we have to understand return on invested capital. So whenever a business makes an investment, what they are doing is they are outlaying cash today in hopes of more cash in the future. Now, the question is, what is their return on the cash they are deploying today? Now, if you were looking at a company like Amazon, they will have spent well over $100 billion just on logistics infrastructure. This includes stuff like warehouses, all sorts of robotic systems to move items within the warehouses, trucks to facilitate moving items between facilities, as well as vans and airplanes. Now, they do all of this because they want to deliver items very quickly to consumers. And consumers, in turn, are willing to shop much more on Amazon. And so the math they had to do was figure out, if we were to spend all of this money on infrastructure, how much do we think customers would increase their purchasing on the site? Now, this is not easy math to do. And sure, there are many different potential ways you could go about trying to solve such equation. However, at the crux of investing all of this money was the belief that it would spur more volume. And the volumes, in turn, would allow them to leverage their fixed cost across more purchases globally. And so when you think about the return on invested capital, they may have done some equation where they thought that spending this $100 billion a year could mean that consumers spend 20% more on the site, and we could end up saving 10% more by insourcing all of these logistics costs instead of relying on third parties to deliver. Now, this is a little wish-washy math because we don't have actual numbers, but no doubt someone internally within Amazon did this math. Now, from the investor's perspective, the key thing to understand is how much of this investment Amazon is making is in order to grow their business versus to just maintain their existing business. And so if we think about a traditional delivery company, they may have vans that they have to replace every 5 years. And so every 5 years, they buy a whole new fleet of vans. When they do this, though, it doesn't help them to grow. It just helps them maintain their existing delivery business. And so there is a portion of capital investment that Amazon is making that is just to maintain their existing business. Now, the growth investment would be new investments in new warehouses, new robots that help them select items quicker, an expansion of their fleet of vans. These would be growth investments, and the growth investments would allow them to generate more revenues in the future. And so when you are thinking of a company like Amazon, and many tech startups do something similar, what they are doing is they are investing so much into their business, except it is disproportionately growth investment. And what that means is these are investment dollars that will bring in more revenues in the future. And so if you were looking at their income statement or cash flow statement today, you will see losses or cash outflows. But that is because they are investing into the future. And these investments they are making, if successful, will generate more profits out into the future. And of course, the point of any investments is to make more money. And so Amazon outlaying $100 billion in infrastructure today, most of that is growth capex. Now they're going to have to maintain some of the infrastructure over time, so maybe that cost them an extra 10 or 20 billion a year, but there's still 80 of it that is growth capex, that is one time. So they pay that money and then they enjoy the benefits of it far into the future. And that is the idea behind maintenance investment and growth investment. Now, a very simple way to understand this is to look at a software company. Software companies very often have very little to no maintenance investment. And that is because for most software, at least good software, if you get a customer hooked on it, they're very unlikely to ever leave because it gets very embedded in their workflow process. It's often mission critical, and it's also often a very small portion of the company's overall cost. So there's very little rationale to ever want to replace it. And so as a result of that, software companies, good ones, have very low churn, which means few customers ever leave. So once a software company acquires a customer, they tend to stay there for essentially ever. And what that means is that they can spend a lot of money to acquire new customers. Because if a customer is giving you, let's say, $1,000 a year, you can spend a few $1,000s a year to acquire them because you're going to be collecting $1,000 a year from them far out into the future. And of course, you could also raise prices on them, introduce new products to cross-sell, and also as you grow your base of users, you benefit from operating leverage. And so these factors together means that a lot of software companies will spend a lot of money to acquire new users. And so this is key. If you are looking at their income statement today, you may see a very high marketing expense line item. Some software companies may even run it as high as 50%. And you may think this is a bad company because they are losing a lot of money. Except what you would be missing is that all of this spend on marketing is quote unquote growth investment. And so what that means is that they could essentially turn it off and be very profitable at any time they want to be. Except they don't want to do that because the money they're spending is helping them compound the value of the business over time. And so if you have a company like that that is spending money on customers with a very high lifetime value or making investments with a very high return on invested capital, you actually want them to see them spending as much money as possible. It is a good thing. And so when you are looking at these companies, what you need to do is look through a mature margin framework. A mature margin framework basically means when this company is no longer investing in growth, what will their economics look like? And that is a more fair way to value their stream of cash flows. Because again, at any point, this company could just stop investing and harvest the profits for themselves. Except they're not doing that because they're continuing to create more future profits for you. And so when you were looking at Amazon in its early history and you saw it was making all of these investments, you had to understand that a lot of these investments, not all, but most of these investments were growth investments that would eventually go away and leaving Amazon with higher profit margins. And now that we are multiple decades out, we can see that is actually starting to happen. We could look at many SaaS companies too. Appfolio is an example of one that lost money almost their entire history all of a sudden to become very profitable in a single year. However, they may then see that there's more opportunities and reinvest back into the business, bringing their profit margins down. You shouldn't punish them for this because what they are effectively saying is that by investing today, we can make you even more money in the future. And again, it is key to remember that what an investor wants in a good business is a company that is able to continually reinvest cash flow back into the business at high rates of return. And so if you were looking at the accounting statements, sometimes that shows up as a loss. Except While it may look like you are losing money, you are gaining economic value. And so that is a more important way to think about the business. Are they creating more value for you over time as a shareholder? And so to just put some numbers on how you can do this, you could look at a company that has maybe a 5% profit margin now, but has sales and marketing at 40% of revenues. And you can do some sort of comparison to more mature companies in similar industries and say that 40% could really be running at 20. And so then that means there's 20 points that will flow down to the bottom line, making their profit margin 25% at maturity. That is the earning stream that you then value. And so that is just a really simple way to try to value a business that is losing money. What you want to do is focus on the economics at maturity, not the several years while they may be losing money as they are investing into the business. Now, one caveat is just because they're making investments doesn't mean they are good investments. That is your job as an investor to figure out whether or not the investments they are making are going to be accretive to shareholder value or destructive. If you have any questions though, please go ahead and drop a comment below and we'll get to them in future videos. And if you like this content, please go ahead and hit like and subscribe so we know to create more content like this in the future.